Welcome to JM Financial Mutual Funds Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We would also look at our view on the Indian equity markets, which may in turn impact the positioning of our schemes. Indian equity markets continue to push ahead with mid caps and small caps outperforming large caps. Indian markets on a YTD basis continue to be among the best performing markets, but have lagged the Nasdaq index as US markets have recovered. The Nifty index ended the month of July on a positive note with a gain of 2.9%. Global indices such as Dow Jones and Nasdaq Composite outperformed the Nifty 50, whereas the FTSE 100 lagged Nifty returns. The India VIX saw a decline in June. It was at 10.41 compared to 10.80 in the previous month, lower by 3.6%. The SIBO VIX was also flat as compared to the previous month. Sector-wise, all sectors ended in green. The Nifty Media, Nifty PSU Banks, and Nifty Realty indices were the top gainers, whereas Nifty FMCG, Nifty IT, and Nifty Financial Services were the laggards. FII flows continued to remain positive in July. Net FII inflows were Rs 34,768 crores. DIIs sold stocks worth Rs 2,698 crores, whereas MFs were net buyers worth Rs 1,648 crores. DII flows have seen some rotation away from large caps towards mid caps and small caps. On the whole, the Indian economy continues to remain robust across several parameters such as tax collections, infrastructure spends, and corporate earnings. Yet, the recent move in equity markets on behalf of aggressive FPI flows makes us cautious. Increasingly, the global headwinds are trickling into the domestic economy as well, and this could dampen market sentiments. Amongst the key issues that we are tracking is the Fed funds rate hike. The US Fed increased rates by 25 basis points to a target range of 5.25 to 5.50% on July 26, 2023, to the highest level since 2001. This further increases cost of money globally and more so differs long-term capital expenditure, thereby slowing the economy. The US fiscal deficit could also increase due to higher interest expenses, which could further lead to increase in government's borrowings. Equity markets are digesting the higher cost of money as of now, perhaps expecting the US Fed to reverse rates sooner rather than later. At the same time, US M2 data indicates that liquidity is tightening, which could further exacerbate the cost of capital. The silver lining, however, is that US CPI inflation has been declining for the past 12 months to 3% in June 2023 from a peak of 9.1% in June 2022. What we remain concerned about is the stickiness in US labor inflation and significant capex that US is committing for green energy and nearshoring of manufacturing. This surge in investments will translate to higher wage costs and eventually commodity prices as well. Higher interest rates have started creating some other issues as well. Mid-sized banks in the US are now challenged in raising money and credit growth has declined sharply. This could affect retail borrowers, small businesses, and mid-sized corporates, helping larger companies. Borrowing costs for smaller companies could increase and cause significant stress. On the domestic front, India's capex expenditure has staged a smart recovery and is likely to sustain. Gross fixed capital formation has declined continuously for nearly 15 years and is now beginning to pick up. GFCF rate declined from 36% to 27% and is currently at 29%, indicating there is significant headroom for sustained growth. Listed companies have drastically cut their capital expenditure and improved their balance sheets. As a proportion of GDP, their contribution has declined from 6.2% to 2.6%. The nascent capex growth is visible after a decade of tepid growth and is likely to sustain. Higher interest rates on a sustained basis could impact flows into equity markets for retail investors. There are some signs of this already, and this could increase as banks compete for funds. Global trade has taken a setback and could revive over the next few quarters. Corporate India is embarking on a capex drive after a long hiatus. This could reduce earnings momentum and capital efficiency in the interim. We expect corporate borrowings to increase and interest and depreciation expenses to reduce earnings momentum going ahead. We see China's re-entry into global export markets as well as any potential stimulus can impact our exports, as well as increase commodity prices. This could hurt top line growth as well as increase costs and affect profit growth. We also expect companies to start raising capital ahead of a renewed capex cycle. This could cause some earnings dilution initially, stalling stock price appreciation. Benign inflation will help boost consumption as inflation has eroded many household budgets. The sharp fall in WPI prices indicate that companies could potentially reduce prices at the customer end as well. Rural incomes have started moving up over the past few months and could help improve a weak consumer sentiment. Our portfolio strategy continues to focus on companies with superior cash flows, which can withstand global uncertainties. We continue to retain our overweight stance in mid-caps. We recommend investors to invest from medium to long term. India continues to be in a sweet spot, and while market corrections and cycles play out from time to time, the long-term growth potential remains intact.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.